Hey everyone, hope you're well and welcome to The Loft. Now today we've got some stories around Omega Healthcare investors and Store Capital, and we've also got a slight update on DTE based on something that I noticed last week. Obviously these are positions that I hold myself, which is why I've come across the stories, but they may be useful to you if you're looking at either entering the position or you currently hold them. We will be finishing as normal with a portfolio update as well, just to see what's happened in regards to my personal portfolio over the last week. So jumping straight into the first story, this one is around Store Capital, which was slightly concerning, but I looked into it and passed the headlines, and then that wasn't as concerning as I thought and as the headlines made it seem. But the story itself is that Christopher Volk, who is the CEO of Store Capital, will be standing down and be replaced by the current COO of the company, whose name is Mary Fedwa, I believe, or Fediwa. So she is the current COO and she'll be taking over, and Christopher will be now chairman of the board. So I'm unsure overall how this is going to affect the company as a whole. I personally quite like Christopher Volk. I feel that he is very transparent, very open on what he's doing, and he is very communicative to not only shareholders but everyone else. He has over 7 articles on Seeking Alpha where he details what's going on with the company and his thoughts on the industry. And he also has over 100 comments where he's actually replied to people asking questions, which I think is a very good thing for a CEO to do and to be very open with things like that. But now that he's no longer CEO, we're just going to have to see kind of where it goes and what happens going forward. Overall, I'm actually okay with the change, as Mary has got a lot of experience in the company. She's been in Store Capital since 2016 and has been the Chief Operating Officer since 2017. So the change hopefully won't make too much of a difference, because they're not bringing in someone from outside into the company that hasn't worked it and will want to revolutionize and change it to how they're used to working. We won't have that issue because she has grown in the company itself. I did check the share price and there doesn't seem to have been much concern from shareholders, as the share price itself actually rose by about 3%. And generally what we'd see is if there were concerns around this new hiring, essentially, there would tend to be a drop-off in share price as shareholders lost confidence in the company and pulled out. In this case, we didn't see that, so hopefully that means that generally shareholders are aware and relatively happy with the change. Naturally, there's not much we can do. All we can do is sit around and see what happens over the next few months and years and see if there is any drastic change in the management of the company. But having Christopher Volk there as the executive chair will mitigate, I believe, any of these major risks, because he would probably step in and stop any major changes that moves the company away from their ideal trajectory on that they're working on at the moment. So with that said, let's move into our second story, which is an update on DTE following some information I researched because of something that I realised in their last dividend. Now, I did mention this in last week's video, and this was a concern around DTE, who paid out their dividend as a form of return on capital dividend as opposed to an ordinary dividend. And generally, this is normally because a company is struggling to pay the dividend in question out of its revenues. And for me, that is a flag. That is a concern if they're not able to cover their dividend with their profits and their revenues. So I wanted to do a little bit more digging. And what I found out is that that's not the case. DTE do always pay their dividends as a return on capital, and this is because of particular tax reasons in Germany. Because DTE are a German-based company, they are governed by German law, and from what I can tell, under German law, the return on capital mechanism of returning value to an investor is tax-free under the law. So therefore, DTE willingly opt to choose to use the return on capital investment back to their shareholders to avoid them having to pay any particular taxes. For me personally, this doesn't make a difference really, mainly because I'm investing using an ISA, so I don't have to worry about tax on any of my investments, whether it's capital gains or ordinary dividends. However, if I was using a UK investing account as normal, I would be paying, unfortunately, tax on both return on capital and also ordinary dividends. And I believe that's the same for both EU and US as well. Obviously, it only benefits actually people in Germany and German investors that are invested in the company. Otherwise, we have to pay tax as normal. So now that I've cleared that up, it's not as much as a concern. I was slightly panicked when I saw it last week, but overall, not that much to worry about. So we're going to move swiftly on to our third story, which is around Omega Healthcare investors. And the title was shown as "Buy This Stock Before It Becomes a Dividend Aristocrat." Now, this title did slightly confuse me because, to my knowledge, Omega Healthcare is still 4 or 5 years away from reaching that milestone. However, at the same point, I do also agree with the title, mainly because if you do believe in the company and you think they're going to do well over the long time, if they do continue to pay and increase their dividends for the next 4 to 5 years, when they reach that milestone of Dividend Aristocrat, there are ETFs and other funds that will pick them up just for that reason. There are funds I know that target just Dividend Aristocrats entirely. So in theory, those funds will start to pick up the company. So we might see an increase in price around that sort of time based on the stock price and the fact that these funds are buying into them. Because as we know, the more funds that are buying into these companies, generally, they tend to go up slightly more. This is why there was a lot of hype around Tesla when there was thoughts that they were going to be entering the S&P 500. Naturally, this fact alone is not a reason to go out and buy this company or any stocks in this company. But if you are already looking into the company, either entering into it or looking to grow your investment, this could be a useful thing to know and be able to forecast the potential for growth of the company in the future. For a bit more information around the company, Omega Healthcare Investors is a real estate investment trust, and due to this, they need to pay out the majority of their revenue and profits to shareholders in the form of dividends. So they specialise in nursing homes, which tends to make up about 85% of their overall real estate portfolio, with the rest being in senior housing and senior care homes and that sort of area. One of the main concerns that I see around this particular real estate investment trust is that they get around 80% of their funding from US government, and this is generally in the form of Medicare and Medicaid, which can be a double-edged sword in the sense of providing those two services continue on going for the future, then there is a relatively stable, guaranteed source of income coming in. However, if in the future the government look to remove those particular services, that could dry up to 80% of the revenues and funding for the company. It's obviously not guaranteed what's going to happen. If that did happen and Medicare and Medicaid got removed, it is potential that they're going to be private tenants that are going to take the places of those services, and therefore their rents and everything will still continue. So we wouldn't be able to tell until that actually happened, unfortunately. But overall, it's not massively concerning for me at this time because as far as I'm aware, there isn't any want in the US at the moment to get rid of those two services. If you want any more information, I have, as always, added the links down in the description below. They're at the bottom of the description, so feel free to go and check them out and smash the like button on your way past. But until then, I will move over to our weekly portfolio update and let's see what's happened over the last week. Jumping straight in with the general ups and downs and the gains and losses of my portfolio, we can see that my portfolio value has increased over the last week, though that's mainly because I did add funds and buy more companies for the portfolio. So my portfolio has increased £3 from £2,761 up to a new value of £2,764. But I have seen a overall drop in actual percentage return of the portfolio, moving from 13.73% down to 13.32%, which is obviously less than a 1% movement, and I'm not majorly concerned. But if we compare that to the VOO, they have also had a drop of less than 1%, but their less than 1% drop was less than my percentage drop. So they did perform slightly better in regards to portfolio changes in value. However, that is potentially to be expected because I have a portfolio beta of around 1.13, which would imply that there is going to be slightly more change in my portfolio compared to the general market. Taking a quick jump over to purchases. In regards to purchases, I did mention last week that unfortunately I was probably going to be low on funds this particular week and potentially not even able to pick up any stocks. But while I was relatively close with that projection, I did still manage to pick up one part of a stock. And this was, in this case, half a share of Kraft Heinz for £11.88, which brings my total position up to 2.5 shares. And they are also likely / planning to pay a dividend in June, normally the end of June, I believe, which is a value of 40 cents per share. So using basic maths, I would be expecting to pull in around 60p for the positions that I hold once we account for the withholding tax. And that is it for purchases. Unfortunately, I only had £12 or something in the account, and that is what I decided to buy with that money. So without further ado, let's jump over to our dividends for the week. And the dividends started and ended on the 19th, with the first one being Medtronic paying out 1 penny for me holding 0.02 of a share. This was then followed by Cardinal Health sending across a total 30p for the one share that I hold. We then had a load of monthly payers. This is Main Street Capital sending over 62p for the 5 shares that I hold. Realty Income sent 43p for 3 shares. Pembina Pipeline sent 20p for the 2 shares that I hold. And Stag Industrial sent across another 20p for the 4 shares that I hold. Then we have, finishing off the day and the week in this case, Store Capital, who I spoke about not too long ago. They sent over £1.09 for the 5 shares that I currently hold. Before we finish, I thought I would jump into the best and worst performing stocks of my portfolio. I do this because 1, I like to be transparent and show you what's going on in my portfolio, and 2, I just think that it's good to know that it's not always green and there are stocks that sometimes you don't buy at the right time. But looking into it this time, the worst performing stock on the basis of percentage was actually Hormel Foods. They are down a total of 12.7% on my initial investment. However, it's slightly different if we move over to the amount of value that I've lost. The company that has lost me the most amount of money over the entire period that I've held them, but showing as of last week, was Dominion Energy, who have lost me a total of £2.15. Flipping that on its head, however, and looking at the overall best returns by percentage, we have ING with a return just shy of 92%, and in return of actual physical money that I could cash out, we've got the winner being Main Street Capital, who are currently up around £36. So, as usual, if there's anything that you thought that I should have included, you wanted to see, if you're sat there going, I wish he'd said this, I wish he'd included this in his particular update, please let me know down in the comments below. It'd really help me out. If you did like the video, please do hit the like button. And if you really didn't like the video, hit the dislike button. All I ask is, if you are going to hit the dislike button, let me know in the comments below what it was you didn't like, and I can look to improve that if possible. And until next time, remember to invest, save, and subscribe.